Hi, everybody. Welcome to another episode of Tax Sale Insiders. I am your host. I'm Brian Seidensticker. I'm the CEO of Tax Sale Resources. And with me today, I got a unique guest, but I'm hoping many of you find this highly interesting. But Brian Davis is the co-founder of Spark Rental, which is a co-investing club. And Brian, thanks for joining us.
Well, Brian, thanks for having me. I got to have you on my show, and we had two outstanding conversations. So I'm excited to pop onto your show.
Yeah, and that's exactly why I wanted to have you on. Kind of learning a little bit more about this, about Spark Rental and this co-investing thing. Made me go, you know what, Brian, I need to have you on. So thanks for hopping on. But let's just start there. Like, what is a co-investing club?
Yeah, so we are a classical investment club in the sense that we meet together as a group of investors. We meet every month. We vet a new investment. In our case, we specialize in passive real estate investments. Sometimes that's syndications, could be private notes, it could be private partnerships, it could be a debt fund or an equity fund. It just needs to be a passive real estate investment. That's our only real requirement. But we vet them together as a club, and we feel that having 50 sets of eyeballs on these deals and, having that kind of hive mind to review the risk from every different angle and try to, poke holes in these deals from every angle, that reduces risk, rather than trying to go this alone and invest by yourself. So we form a new LLC every month for that month's featured investment. And that LLC will become the investor in whatever it is that we're looking at together. But each individual member can invest $5,000 or more in that month's investment if they like it, as opposed to the typical 50 grand, 100 grand that you need if you're going to invest in private equity real estate syndications or some of these other passive real estate investments.
It allows, certainly correct me where some of my assumptions are incorrect, Brian, but it allows investors to participate, right? Because they're buying equity in this LLC, and then the LLC can potentially participate in some investments that require like accreditation. Only available to accredited investors, right? Only a minimum investment of $50,000 or $100,000. Investors can take part in those investments because they're grouped together with a larger pool of folks. Is that accurate?
So yes and no. So on the accreditation piece, every investor has to be accredited in a joint LLC like that. If the LLC is going to count as an accredited investor. So historically, we have not invested in 506c funds or syndications that require accreditation because part of our mission is making these investments available to everyday people, to middle-class people, who are maybe not yet accredited. So we have mostly invested in stuff that is open to non-accredited investors, even though at least half of our members are accredited. That is part of our mission, just inclusivity, making these investments available. So so that is one point that I want to make. But as far as the minimum investment goes, that's exactly right. That is a huge barrier to entry for these types of investments. Most people don't have 50 or 100 grand just sitting around collecting dust that they're looking to invest. And even if they do, if you have to plop down 100 grand in each separate investment, it makes it really hard to diversify, right? Whereas I use this, so I invest my own personal money every month as just one more member of the co-investing club. And that's part of the transparency and the authenticity behind this is that my partner and I founded this club for ourselves too, because we wanted to do this ourselves, spread smaller amounts across more deals. But I look at it as a way to dollar cost average your real estate investments, which is otherwise really difficult to do. I mean, dollar cost averaging, for anyone who's not familiar with that term, it's really a term from stock investing where, every week or every month or, on some kind of regular cadence, you are investing the same amount of money in the same stock investments, whether that's an index fund or, whatever it is. And this is what I do with my stock investments as well. I have a robo-advisor, and every week it just pulls a certain amount of money out of my checking account, and then it will automatically invest that to keep my stock portfolio balanced and so forth. But this is a way to dollar cost average with my real estate investments as well. Every month I'm putting in $5,000 in a new real estate investment, hands off. It doesn't require me to be a landlord or anything like that. But I get to spread my money across a lot of different geographical areas and a lot of different operators and different types of real estate and different investment timelines. So it's a great way to diversify and just keep plugging money in every month into something new, not trying to time the market, not trying to pick the next hot city or hot asset class or whatever. This is how I approach my personal investing, and this is how we encourage our members to think about their investments as well.
Well, it's you mentioned diversification, which is very important, right? At least from my perspective, some people would say, no, you should put all your money in Apple stock 20 years ago. Yeah, that's also a little bit like buying a lottery ticket, right? Hindsight's always 2020, and we talk about diversification in our fund as well of the different states, different markets, different asset classes, and that way, if a property goes south, it's not totally detrimental, right? And so it's the same concept of spreading that out. Maybe not every investment works out the way you hope, but on average, most will, right? And that's really where you win. And that way, you don't have to stay awake at night wondering if that one property is going to burn down or not, right? So it's very, very easing of the mind, right? And compared to a lot of investment opportunities.
Well, just one added point on that. So the way that we think about that is that if you think of your investments as a bell curve, the returns that you earn on your investments as a bell curve, if you can only invest in one syndication a year or maybe two syndications a year because you have to pay that full 50 or 100 grand, those are going to end up anywhere along that dot plot of the bell curve, right? Including in the negative territory, negative returns. But when you can spread that out across 10, 12 deals a year, then your returns do form that bell curve. So it's a much easier way to sleep at night, where you're going to have some deals underperform. That's inevitable. You're going to have some deals overperform. That's great. Most are going to be in the middle. So they're just going to average out at the end of the year, and it just becomes numbers on a page. So you're just looking at what's the average that I got across those 12 deals a year or whatever, instead of, like you said, chewing on your fingernails and laying awake at night because you put 100 grand in one deal that might be on the bottom left-hand corner of that bell curve where you don't want it, right? So yeah, it's a much lower stress way of investing.
Yeah. I got a million questions for you, Brian. We'll get to some of them, and I'm sure listeners have a million questions too. But things that come to mind as far as is every LLC that you form might have different people in there, and so who is ultimately managing those LLCs? From an annual tax preparation, K1, all that kind of stuff. Is that something that your group does, or is that defined one by one? How does that work?
Yeah, so we, as the joint LLC, we get one K1 or one 1099 INT, if we're getting interest payments instead of distributions or whatever. At the end of the year, we send that off to our CPA team, and then they will divvy that up and send out each individual member's K1 or 1099 INT or whatever the appropriate tax document is for each individual member. So when members participate in a deal, we all just split those costs together. Currently, that's $75 a year per participating member. We're hoping to get that down even lower. But it's a small price to pay to be able to go in on these with a lot less money.
And that $75 a year covers essentially the accounting costs of keeping that LLC legitimate, right?
Yeah. Filing the LLC tax returns, divvying up all those K1s or 1099s, and just covering administrative costs of sending everybody their distributions every quarter and keeping all of the books clean.
Okay. Now, are there any other kind of management fees associated with maintaining that LLC or participating in the investments above and beyond that?
So that covers that LLC that you're participating in. The club it's a membership fee. We are a flat fee subscription model business. So we are not a fund of funds. We don't get a cut of any of the returns, anything like that. All of the returns just flow directly through to people participating in the deal. Membership in the club is $59 a month or $497 a year. And again, that's our profit, right? I mean, that's how we keep the lights on. And it's also how we, weed out who's serious about investing. This is a niche club. It's not for everybody. These are, one way of putting it is alternative investments, these passive real estate investments that we're making. And we only want people in this investment club who are serious about it and who are here to invest. Like I said, I myself am putting money in as just one more member every month. But people who have skin in the game, they show up to the deal discussions, and we vet these together. We all grill the operator together. We bring them in and we all sling questions at them until we feel comfortable making a yes or no decision with our money about whether we're going to invest, each one of us individually in that deal that month.
Yeah. Very interesting. Well, one of the reasons I wanted to bring you on and talk through some of this, Brian, is I field a lot of questions from our customers or subscribers of Tax Resources and people that want to participate in buying tax liens. And I guess in my personal opinion, I think you need 50, 100, 1,000 or more to really make the time worth the effort of buying tax liens, right? You're buying, let's say $500 to $5,000 a piece, right? You're going to buy several of those, and you got to somewhat manage those. And it is passive, right? But doing that for one or two liens for $5,000, $10,000, that's a lot of work, right? So one of the things I thought was outstanding is this advent of working, I guess, through you, with you, right? And joining forces is if, for folks that don't have $50,000 or $100,000 to really do that, they want to participate in these different alternative asset, real estate, back type asset classes, then this is a way that they could participate, right? So anybody that's listening that, if is going, like Brian's talking to me, then I'm saying, go talk to Brian, other Brian. But so I guess, to kind of, further explore this a little more, what kind of, what are the last 3 or 4, types of investment opportunities that you guys have kind of vetted and move forward with? Like, give me a sample of the array of types of investments that you guys participate in.
Yeah. So the last one that we did was a little unusual, although in some cases they're all unusual, right? So the last one we did was a secured note at a fixed interest rate. It was at 15% interest. And the operator is a land flipping company, and they have great cash flow, a very long, deep track record. But we also try to secure some kind of extra downside risk protection in all of our deals. We try to find some kind of differentiating factor that will give us those asymmetric returns where we have high potential returns, but lower or medium risk on these. And in this case, what we negotiated with this operator was a lien against his primary residence, and a first position lien. Actually, he happens to own his residence free and clear, and he agreed to put a lien against his house for this note. Now, the downside to this was that we were capped at how much how much he was willing to borrow from us. So we made that one a bonus deal that month, not the featured monthly deal. But yeah, I mean, a couple other recent ones that we did one a month or two back that was a property tax abatement deal where the operator partnered with the local municipality to set aside half of the units for affordable housing. And in exchange, they got a 50% property tax abatement. And what's great about that is that you have an instant bump in NOI and net operating income for the property, because the loss on rents was tiny. I mean, most of the units actually didn't have any, they were already renting for within the range that was allowed by this deal. I think a couple of the units, maybe they had to lower rents by $20 or something, but they're saving 6 figures a year in property taxes. So it's a way to add value to the property without swinging any hammers, right? Or, doing any renovations, which of course adds its own risk. So, instantly from day one of buying this property, they bumped up the value of the property significantly by boosting the NOI on the property. Because of course, commercial properties are priced based on their NOI. So, and the one other comment about that strategy, the property tax abatement strategy, we've done a couple of those deals and we like them. There's some built-in recession resilience in those, because those those units where the rents are capped and set aside for affordable housing, there's often a wait list for those. And in a recession, those would become even more coveted, right? So we like that. That's one example of a recent deal. But we do all kinds of stuff. Earlier this year, we did an industrial seller-leaseback deal where the operator they bought the real estate of an industrial company's plant because the company wanted to expand and grow, so they needed an infusion of capital. So they sold the land itself and the buildings where they operate to this operator. So all kinds of fun stuff out there that we do. Every month it's something a little different.
Yeah, well, I think that's one of the cool parts, and I guess being on your podcast and learning how you put that together, what lengths that you go to help identify these unique opportunities. You and I, we spent probably 25 minutes talking about unique angles and niches that that we've come across, right, that you could talk about, because that's ultimately what you're trying to get. And I thought that was really cool. What I guess you mentioned the $5,000 like minimum investment, but what would be the most you've seen somebody put in, and like what is a typical amount that each an LLC, right? Each month is an LLC. That what is the typical amount that LLC typically invests in something?
Yeah, so it's grown a lot over time as our club has grown. Right now, we're investing between 400 and around 850,000 each month in deals as an LLC, together as an LLC. The average per person investment in these deals is around 10,000. A lot of people come in at the minimum $5,000 level, which is totally fine. The most I think I've seen an individual person invest in a deal was 100,000. And the kind of logical question, for that is, well, why wouldn't they just go and invest directly with the operator at that point? And there's a couple answers to that question. One is that we often get enhanced terms on our deals just because of the total amount that we're investing. So sometimes we'll get a higher preferred return or a better profit split or both. Some of the deals that we do are privately negotiated by my partner and myself with the operator. Not all of these are open to the general public. For example, that secured note that we did earlier this month, that was something that we negotiated privately with that land investing company, that land investing operator. That's not open to the public. So on some of those privately negotiated deals, we do see higher participation or higher amounts from individuals, because they can't just go and invest by themselves with that operator. But yeah, some of the stuff is super niche and weird. I mean, we did a deal where we partnered with a spec home construction company, and their niche is in the counties where they operate, and they only operate in a couple of counties, but they don't need zoning permission to subdivide lots to up to 3 new lots. So what they'll do is they'll find tear down houses, properties that just need to be totally bulldozed on oversized lots, on really big lots, and they'll bulldoze the house, and then they'll build 2 or 3 new houses and split that lot into 2 or 3 new lots. But they don't have any of the zoning risk that normally comes along with that, because the county allows it, or rather has a streamlined process that they are very familiar with, and they know everybody at the zoning office in those counties, and it just gets rubber stamped. So we're doing stuff like that it's just it's kind of goofy niche stuff that you're just not going to go out and find on your own necessarily. So that's part of the value that my partner and I bring. Is part of what we're doing as organizers of this investment club is just relentlessly networking with operators out there, big operators, small operators. I mean, we've invested with some of the biggest operators in the industry, and tiny operators that no one's ever heard of, and that's part of the fun.
Well, I'd say, so how many years and how many different investments have you guys participated in?
Yeah, so in its current form, the co-investing club has been around for 3 years. We did a couple pilot deals before that, you're going back 4 or 5 years. But we were still kind of experimenting. We did a couple single family deals. But yeah, in its current form, about 3 years, we've done around 35, 36 deals total at this point. We're meeting tomorrow to vet another one. Yeah, so at this point, in some months, we're doing 2 deals. We have started doing more bonus deals, as the club has grown. So we'll probably close out 2025 having done 16 deals total, maybe a little bit more. We'll see.
Got it. And then I know, like you said, it's a bell curve, right? Some perform better than others, but do you have any idea, like on average, how well those have performed in aggregate, those 36 over the last 3 years?
Yeah, so there's a couple answers to that question. Only one of those deals has gone full cycle. That was a short-term note that was at 15% interest. It paid out its interest and paid us back in full. We've seen a couple of these kind of go awry, as you might expect, as sort of the bottom left-hand corner of that bell curve. We've seen others exceed expectations as far as cash flow, as far as refinancing to return our capital. And that raises one other point that maybe people are not familiar with if they're not familiar with passive investing is you can sometimes achieve what they call infinite returns with these types of investments. It's not just for BRRRR deals. So if people are familiar with the BRRRR strategy, buy, renovate, rent, refinance, repeat. That's like the classical like infinite returns model. You can maybe get your down payment and closing costs back out of a property and then go reinvest it and keep earning more returns on the same money. The same thing can happen in passive real estate investing as well, just at a slower pace, where someone maybe goes out, they buy an apartment complex, they renovate it over the course of a year or two, and then they refinance it to return our capital as well. But we keep our ownership interest in that property and we keep collecting distributions on it, keep collecting cash flow, even as we can go out and redeploy that capital somewhere else and keep earning more returns on it elsewhere too. So anyway, going off on a little bit of a tangent there. But yeah, so we aim for returns in the mid-teens or higher typically on the deals that we do. Otherwise, if someone were just looking for 8 to 10% returns, then go buy an index fund, right? You don't need to pay us a monthly fee to be able to access that. So we do want to try to find those slightly higher returns, mid-teens or higher. But again, we also look for some kind of extra downside risk protection because we don't want to lose money on any of these deals. So yeah, we look for asymmetric returns on all of these investments, whether it's a syndication, a fund, a private note, private partnership, whatever it is.
Interesting. Very cool. Well, we're going to move into a slightly different segment I call Carveouts, and I commandeered that term from another podcast I love listening to. But before we do that, I guess, is there anything else on the co-investing club, Brian, that you'd like to mention?
Yeah, as a closing thought, I mean, one of the reasons that I got into passive real estate investing in the first place is I lived abroad for 10 years and I actually just moved back to the States within the last month. But you can invest passively in real estate from anywhere in the world. You don't have to be local. And I realized that, with active investing, yes, you can buy turnkey properties across the country, but that's still that still takes some work. And it takes some boots on the ground and some familiarity. It's still a side hustle. Passive investing, you can wire money from anywhere in the world. And that was what I did. And it's the way I like to invest. Yeah.
No, very cool. Yeah, it opens up opportunities that a lot of people don't know that are there. And hopefully, many of you listening right now were as wide-eyed as I was when you started talking about what you did, Brian. And I was kind of like, you do what? Yeah, we gotta talk about this in more detail. So I appreciate hopping on. Okay, so moving into Carveouts, I'm going to catch you a little bit off or by surprise, Brian. But this term that I got from a podcast I love called Acquired, and at the end, these two hosts that are amazing. Basically, anything that they came across, bought, watched, read, whatever, over the last month that they thought would be highly beneficial to anybody out there. It can have nothing to do with what we talked about today, but I love mentioning it. So I'm going to give you a little time to think. So I'm going to mention these couple carve-outs, and one of them is actually a recent episode of this podcast. Again, the podcast called Acquired, but they talked about Epic Systems, which is the developer of, most people know MyChart if they're in the medical system, but it talks about how this founder that created this company, and it's never been they brought in very little initial capital. They're now $5 billion in revenue. They have it set up to where it will never be sold because it's going to be owned by a trust in perpetuity, and just an incredible a story of creating a company in an industry that I think a lot of it, for me, right, I was always very nervous about this whole MyChart thing and making these records available on the internet. But I think anybody that listens to this episode will go, you know what, Epic is just different than most companies out there. And so that's one of my carve outs, is go listen to this podcast episode about Epic Systems from Acquired. The other one that I guess is more totally unrelated again, but it's I don't think it's new for anybody, but I recently went on vacation with my family up in northern Michigan, and we spent a lot of time unplugged, by design, right? We kind of arrived, the kids, watched their tablets all the way up there, and they had, I don't know, 15-20% of battery life, left, and they woke up the next morning and they wanted to watch the tablets, and I told them, I said, that's fine, but when they run out, they're done, right? You're done for the week. Well, an hour or so later, they both ran out. And I tell you what, because we were unplugged, we were, hanging out on the lake, we had things to do. They never even asked to watch them again. And I think it's just important for anybody out there that's looking at their lifestyle going, wow, this is just nuts, of just giving yourself the opportunity to go have something that has no agenda, and has other things to do that doesn't involve, you and I probably sit and stare at our computer screens way too much, right? Monday through Friday, and how doing that for a period of time during where me as a business owner really feel like I should or deserve or have time, right, to take time off, but coming back and how immensely recharged I was. And so anybody that's listening that is starting a fledgling business and is afraid to take some vacation, I will say you need to, because it's amazing what it can do for you mentally and physically. So there's my two carve outs, Brian. I don't know if you had enough time to kind of think about a couple on your end, but what do you have any?
Yeah, and I appreciate you giving me a little time to pull my thoughts together there. So I've been listening to The Science of Scaling by Dr. Ben Hardy. You might know his name. He collaborated on a couple books with Dan Sullivan, a famous entrepreneurship coach, and those books were great, by the way. I've read 2 out of the 3 of them. Highly recommend them. And I am absolutely loving. I got an advanced copy of this actually through a mastermind group that I'm in called GoBundance. And tomorrow, actually, they're bringing in Ben Hardy to come and speak in front of the mastermind group, which is awesome. But yeah, so check out The Science of Scaling by Ben Hardy. I think it gets released in late July of 2025, a week from when we're actually recording this. And while I've been sitting here at the beach, on a family vacation, I've also been leafing through. I've been reading Tribe of Millionaires. Speaking of GoBundance, it was written by the founders of GoBundance, and it's structured as a fiction book, but it's a personal development book with life lessons, business lessons, entrepreneurship. So yeah, those are 2 carve outs that over the last month I've been consuming.
Very cool. Appreciate it. Well, Brian, I guess if anybody wants to reach out to you and connect with you on the Co-Investing Club and Spark Rental in general, how do they do that?
Yeah, sparkrental.com. You'll see the Co-Investing Club front and center right there. You can also email us, support@sparkrental.com. We are a small team. I mean, there's only a few of us. It's very much a mom and pop business. So, you will reach us. And we're all on the social platforms at sparkrental.com. So, Facebook and LinkedIn, Instagram, we're on X and the others, but the main ones are Facebook and LinkedIn that we're on. So come check us out. Say hi.
Thanks again, Brian. Thanks everybody for listening, and good luck with all your investment ventures.
Brian, thank you so much for having me. This was a blast.